Welcome back. It is now time for the Canada Tonight Spotlight, and we turn that spotlight on best-selling author and economist Jeff Rubin. As Canadians struggle with continued high interest rates and the rising cost of living, I sat down with him to ask about inflation in this country and what is driving it. I do want to touch on the carbon tax. Of course, everybody's talking about it, and much has been made of the leader of the opposition, Pierre Poilievre, and what he is saying about the carbon tax and its role in inflation. Settle this for us once and for all, if you can. What effect, if any, does the carbon tax have on core inflation, or does it?
Well, it has perhaps a more noticeable effect on food and energy prices, because carbon is a major input into the production of food and energy, and that's where it's being born. And it's come at a time when food and energy prices were already soaring for reasons of sanctions. Mm-hmm. So, yes, it has been a contributing factor to inflation. And I think that in this country and south of the border as well, the number one issue on voters' minds going into the coming elections will be inflation.
You think that's the ballot box issue?
That's the ballot box issue.
Okay, let's talk about sanctions now. In February 2022, Russia launched its full-scale invasion of Ukraine, prompting a slew of sanctions from the West on Russia. It's been over 2 years since the start of that war, and Russia's economy appears to be surprisingly resilient. Yeah, I mean, to all of these sanctions, and in some cases even, really thriving in a way. What did the West miscalculate when it came to the power and diversity of Russia's economy?
Oh, so many things. The first thing to recognize is that when you sanction the world's largest energy and grain exporters, there are consequences for the price of substitutes. Okay. And we saw grain prices and oil prices just skyrocket. Secondly, Russia has been preparing itself for sanctions for at least the last decade. They were originally imposed after the annexation of Crimea. Thirdly, and most importantly, in the past, sanctioning Russian energy exports to Europe would have brought the Russian economy to its knees, but not anymore, because China and Russia and India and other BRICS countries have welcomed with open arms every bit of grain and energy, natural gas, oil, that Western countries have sanctioned. And these are the countries that are the fastest growing countries. I mean, the first five fastest growing countries in the last 20 years are all BRICS countries. The US is like 12th. So what's changed in the past is this new global order, that it's not just a unipolar world where Washington and its Western allies can dictate economic and military terms for the rest of the world. And that's been an incredible safety valve. And the irony being that last year, Russian export earnings hit an all-time high.
So this is a big wake-up call for the West.
I think so. It's totally backfired.
So not only were these sanctions ineffective in your view, but they had what you call a boomerang effect on countries imposing those sanctions. Let's talk about that a little bit.
Well, let's talk about Germany and the UK. I mean, let's talk about the whole EU. It went into recession. It went into recession because all of a sudden energy prices skyrocketed. Now, we didn't fall into recession because North America is a lot more energy independent than Western Europe. But nevertheless, the rise in interest rates, when interest rates rise rapidly, there are financial accidents. We saw a couple of regional banks go under. We saw the biggest sell-off in the U.S. bond market since the American Civil War. And, of course, that's taken its toll in the housing market because mortgage rates aren't under 2% anymore. They're 3 times that, and I think they're going to go even higher.
You do?
Oh, absolutely.
Okay, well, that's worrying. How are Western economies supposed to adapt in the wake of us tamping down on the global free flow of goods?
Right. The new mantra is friendshoring. or decoupling. And what that means is that we should trade only with our friends at the exclusion of our enemies. And that may sound great for a security of supply standpoint, but it doesn't make any economic sense because our friends are high-wage economies just like ourselves. And all of a sudden, if Apple is going to be making its iPhones and iPads in Cupertino, California, where it's based, and paying $15.50 an hour labor, instead of being supplied by Foxconn, paying Chinese workers $1.50 an hour labor, then guess what? You won't be able to afford to buy any Apple products. And what holds true for Apple holds true for all of those American corporate titans with supply chains based in China.
The evolution to a jack-of-all-trades economy, is that the new normal that you're predicting in this book?
That's the new normal. I mean, first of all, that was a message that Donald Trump first espoused and was ridiculed by the Democrats, even though now they're saying exactly the same thing. So in a global sort of trading system, it was the idea that you specialize in your comparative advantage, okay? And we were told that that makes everyone better off. Today, it's the opposite. Today, we have to be a jack of all trades. And we started learning that lesson during the COVID shutdowns when all of a sudden global supply chains didn't work. And we weren't talking about lawn chairs or footwear. We were talking about respirators and drugs and masks during the greatest public health crisis since the Spanish Civil War. I think that many people started having second thoughts about globalization, but this has taken it to an entirely different level.
We would be remiss if we didn't ask you about the new job numbers that are out. The Canadian economy added 90,000 jobs in April, much higher than predicted, and unemployment stayed flat at 6.1%. Where do these numbers put us as we head toward another Bank of Canada interest rate decision?
Well, it's a very interesting question. I said interest rates are going up because the Bank of Canada is not going to be cutting interest rates, and that's very much priced into the mortgage market right now. I mean, at the beginning of the year, the market was expecting 6 Bank of Canada rate cuts. Now they're expecting 3. By the summer, they won't be cutting any. And long-term interest rates are below short-term interest rates. It's a very unusual situation. It's called a yield curve inversion, but it's there because the bond market is expecting the Bank of Canada's rates to fall. If they don't fall, long-term interest rates are going back up, and that's what your mortgage rate is based on.
Okay, last question here. I mean, I got to admit, the book does not paint a very pretty picture for Canada right now. Is there anything that gives you optimism when it comes to Canada's economy and the years ahead?
Look, I mean, it is what it is, okay? There are some silver linings. I think the return of middle-class jobs is one consequence of friendshoring. But I think it's really important to see clearly. And that hasn't really been the case because, as I say, it's hard to gain a perspective on the new normal when everything we see is through the fog of war.
Canadian economist and author of the book, A Map of the New Normal, Jeff Rubin, joining us here on Canada Tonight. Thanks.
Okay, great talking to you.
You too.